I first met John in 1997 when he was the CEO and co-founder of Silicon Energy. John is truly one of the pioneers of our sector, serial entrepreneur, been in the sector as long as anybody from an entrepreneurial side. When Silicon Energy was acquired by Itron, who we heard from yesterday, Malcolm Unsworth was here. I know that Itron did their very best to keep John for as long as possible, kept increasing his roles and responsibilities, ultimately became VP of Strategy and Business Development for Itron until he left to think about what his new venture was going to be. And after thinking about a number of different areas to explore, ultimately became the CEO of Brightsource Energy, which we're going to hear about today. Tom Tiller. Tom is someone I met about 18 months ago. In fact, I think Tom came to this event last year about 3 or 4 minutes into the job. And I'm an investor in Abound. We were doing a CEO search, and it was somewhere around, I think, Q4 2009 that Tom walked into my office, and I got to really know what a great guy he is. He was one of the senior executives at GE for a number of decades. Heard about all the areas within GE that he's turned around. I hope we can get into some of that. Was a Fortune 1000 CEO for the last decade, and Tom is the penultimate example of someone who has actually taken his personal and professional life into the clean tech sector by accepting the Abound position, has done an incredible job with the company in his year with it, including navigating Abound through the loan guarantee program. I think it is the most recent announcement of success in the venture-backed space, at least, with the $400 million award announced in Q4, and John's award was $1.6 billion. 1.4. Earlier than that. So I want to get into all of the detail with you guys. I think why don't we start, because having just heard from our 2 prior speakers, these are examples of both companies as recipients of the loan guarantee program. It's really taken each of your companies to a different level in terms of ability to execute, ability to roll out. Maybe just from a philosophical standpoint, having just heard our morning speakers, do we need a loan guarantee program, and if so, why?
Do we need a loan guarantee program? I think the way I would start to frame an answer for that is to think about the characteristics of the program, because there are some really good characteristics of it. I've been a big fan. It started back for nuclear plants. And one of the key components early was for large financings where there wasn't enough credit capacity, the loan guarantee program would be appropriate for anything over sort of $1 billion. Some of the nuclear loans out there are $7, $8, $9 billion. So when you need that type of debt and that size of deployment, I think it's a very interesting and attractive program. Yeah. Some people think of it as really low cost capital. It's not that low, especially given the fact that right now you can finance wind project or any renewable projects at sort of LIBOR plus 300, 350 or so. So it's got attractive terms, but it's not going to fundamentally reshape a project as much as it's been very interesting in bridging through. I think we got lucky on a few things with renewables. It's bridged through a very awkward time.
Yeah, but in the competitive... No. Keep going, Tom.
I guess from my perspective, the answer is yes. If we're, at least in the solar space, and you talk about a PV manufacturer, I think when you look at the money required to achieve scale without some form of government support, whether it's loan guarantee or some other vehicle similar to that, I think the practical reality today is that it would be virtually impossible. That may be different 10 years ago with different economics, but today that's definitely the case.
Yep.
And while Ira's getting mic'd up, I'd like to make one other comment, which is, and this really echoes on what Tom, if you look at a lot of what we do in solar, it's a global industry, and a lot of other countries are providing incredibly low cost of capital to support some of their manufacturing, and most notably China. When I was in China last November, they weren't very impressed with the size, scale, or the interest rates from our loan guarantee program. Your typical PV company in China has lower cost of capital. They can get 3.5% money, billions of dollars from the Chinese government. So there's a little bit of an interesting playing field out there that this helps to normalize somewhat.
I think you hit the nail on the head. And the reality is, you probably know the numbers better than I, but in September, China announced for what, LDK, JA Solar, billions of dollars of support that actually pale in comparison to what we're doing here, in terms of competitiveness for your companies in the solar industry. Talk about that.
Yeah, on the order, depending on whose numbers you believe, on the order of $16–18 billion. And I think, the numbers our numbers pale in comparison.
Yeah.
So, I think the question is does the U.S. need a renewable energy industry? And I think it does. If we do, then I think we got to get in the reality of the world, and we have to play ball in some form or fashion. Now, does it have to be exactly structured the way it is today? No, there's probably a bunch of different ways you could go about doing it. But I think if we're going to be, as in any other major industry, if you look at the airline industry where government subsidies prevalent in that, sure, airplanes, any major, the energy industry generally.
Absolutely. Why don't we get an update from each of you? I referenced the size of your projects, but why don't you just maybe give us a quick status update on where you sit relative to when you applied, when you got the conditional approval, where you are in the application process, and how it's going.
Thank you.
Yeah, so when we looked at, Ivanpah is the first project that we're financing under the loan guarantee, and we started this really back it was a Bush program that started in 2005. We actually did the first applications in 2006. And when we looked at this, we thought that it was an interesting program, but at that point we really didn't know what to expect. There had not been a lot of success at that point with it. The program had not deployed much capital, and even the nuclear facilities were everybody was having a hard time getting through. So the good news is we started early. It takes some time to get through the process. We've seen the process change dramatically with the addition, particularly of Jonathan Silver, who was here earlier, and the team that he's brought in. They've built really a very capable group who can analyze and move things forward. So there was a very significant improvement in the capabilities of the program that now will allow things to get processed faster than our 4-year perspective. We did a pre-application. That pre-application's been accepted. We were selected into what was called the Sweet 16. It was the first
batch.
16 applicants. And then you go through a very long process to negotiate the actual term sheet, which is, some of the issues were brought up earlier, how your loan coexists with the ITC and the ITC grant. And so these are complicated financings, and it takes quite a bit. It's not that different at that point from negotiating with a commercial bank.
Yep.
Our team's done 20 gigawatts of coal and natural gas and large power plants, and what we went through in what I will call stage 2 was not that dissimilar to any billion or any financing over $1 billion with complete due diligence by independent engineers. The debt's rated by Fitch. You pick Fitch or S&P. They go in and rate your debt. And at that point, you then go to the final agreements and can be prepared for closing.
Tom, I know our board meeting when we first brought this up was before you joined, but when you took the helm, you really navigated this to completion.
Right. Abound, I think, is a little bit different situation than John's in that it was a young company. So Abound had been in existence for just over a year when we made the decision to apply for a loan. We thought that might be a fairly lengthy process, maybe 6 months or so. Turned out we started before the ramming speed apparently took hold because it was about a 2-year process for us. So we began in November of 2008. We anticipated maybe 6 months. Actually closed the loan December 9th of 2010. Right. So just over a 2-year period. A very complex, for a young company, a very complex transaction. Lots and lots of back and forth and negotiations and consultants and bankers and engineers and reports and reviews. I think the initial application was 600 pages. That was just to kind of get your foot in the door, and then it sort of went from there. So it was a big, long, expensive process.
It'd be helpful to understand the decision-making around whether or not to actually engage in a process like this. And I want to just broaden it beyond the loan guarantee program. As companies and entrepreneurs are thinking about whether to try and access either loan or grant or other types of non-dilutive capital, either in this country or even others, How do you guys think about this trade-off? You referenced cost of capital, John. It'd be great to know, what kinds of metrics or how you think about that, particularly given the other costs, the non-financial costs on dealing with some of these programs.
Yeah, when we looked at the loan guarantee program, what we thought was interesting was that you could actually do something at a size and scale that was more difficult to do. And we would have likely done we've got 3 projects at Ivanpah. We would have done them separately without the ability to do them together. Doing them together allows you to drive costs down further. It allows you to get your EPC cost and efficiency. So, but the initial decision to enter was one that I had to overrule our chairman and others because there was a lot of skepticism. Our company had been associated with DOE and a lot of the events in the 80s, built the 9 largest solar plants in the world through the 1980s, and was very skeptical about it. And we had to work through and say things might have changed. I didn't know for sure. We actually put in the preliminary application. We saw teams and capability getting built up, but the decision was one that was entered into by our company with some level of skepticism. And then, so we never counted on it. We actually built everything assuming it would never go through, because you've got to make sure that you've got backstops and you've got other ways to go through, because you don't want to be dependent on any one thing.
Yeah.
So you always look at how could you shrink the project, how could you change it, how could you do it with commercial lending. Because you don't know, especially when you're one of the first through. And part of our job is, if you're running a company, is to make sure that you've got a contingency plan.
And talk about this contingency. What were the alternatives? How did you weigh them against the process of going down this path? Were there other countries you looked at, and how'd you think about that trade-off of being local versus being somewhere internationally?
Yeah, well, frankly, within the U.S., the contingency plan would have been to do the 3 projects separately, and we were engaged with banks on how to do that. Separate them rather than together. But actually, one of the contingency plans, and I'm glad we didn't do this, was we were over talking to in China, who really wanted to move a lot of things over there. There was a lot of pressure, a lot of dialogue, and just as an American, I was really glad that we were able to compete, get things together, and have the center and the nexus of a lot of what we did at the beginning here, rather than there. But it was amazing, the competitive cost of capital over there, and the subsidy dwarfs anything we see here by an order of magnitude. Yeah. It's phenomenal. Every solar company has provincial access to 2-3% money and lots of it, and so it's very difficult to think through. How do you merge venture capital with returns that so we bring in venture. We bring in corporate debt. We bring in, it's all about capital formation over time. And certainly our blended cost of capital is a lot higher than our counterparts over there.
Interesting. Tom?
I guess in our case, when you start, what are you trying to do to start a thin film solar company? There were, at the time, dozens and dozens and dozens of people that were trying to break into the solar market. Everyone could see the explosive growth and the opportunity. Our bet is that this ultimately turns into a cost game, and we have to be the lowest or about the lowest cost manufacturer in the world. And so to do that, you need 2 things. You need terrific technology, and you need scale. So if you say in the solar business, scale is defined on the order of a gigawatt, and capacity costs on the order of $1 a watt, you got to find $1 billion. That's a lot of money to try to raise privately. You might say it's almost impossible to raise privately. So we needed a significant chunk of capital, whether it's from the U.S. government or from some other source, to really help supplement the private money that we raised. And we thought we had the technology to get there, but we had to pair that with the funding. And so I think there will only be a handful of companies out of those dozens and dozens and dozens that ever get to a gigawatt type scale. And I think what the loan guarantee does for Abound is gives us the potential to get there. It's certainly not the guarantee, but it's the potential to get there. So it's very, very significant for our company.
Let's go from the philosophical maybe to the practical. I mean, I had a front row seat in Abound's case, and at least Tesla's seat, watching the amount of internal resources it has taken to navigate this, I think would be helpful to people to understand, because as you guys think about your own trade-offs, I think you just need to know the practicalities of this huge upside if you get it, but what's the internal investment?
It's a major chunk of time for the senior management team, and in particular for our CFO, who was kind of, Steve Abley is the guy that kind of spearheaded this whole thing for us. And Steve, I would say, probably 50 to 70% of his time. We were fortunate to find a couple good external consultants who were able to help us, and then the lawyers and the consultants, and then the drain on internal resources, engineers and scientists and manufacturing people and so forth, in terms of explaining things and re-explaining them. And I think we've had 3 or 4 sets of consultants that have been in that have looked at things, and you have a wide variety of backgrounds and experiences there. So it's a pretty major undertaking, millions of dollars, I think, by the end, in terms of what it will cost.
I'm not sure if Tom would agree with this or not, but I think that if you're raising $1 billion and we're looking at $2 billion, that takes resources, whether it's with the U.S. government or
Absolutely.
No matter what. So I don't think that the internal resources that we have or that we deployed were really much different in aggregate than we would have to raise $2 billion through any combination of means. We've basically got a mini investment bank internally.
Were you able to see some of the streamlined processes that Jonathan and teams installed since the early days of loan guarantee?
That helped a lot, because there was a lot of hurry up and wait as they were defining.
Because comparing it to the
processes.
private side assumes parity in internal process, which I know it was what Jonathan has tried to create.
And it's gotten really close. So I think that it's really important to, if you're going to raise $1 billion or $1.5 billion of debt, you're going to raise $500, $600 million of project equity. The equity doesn't come in because they're nice guys and they come in because they send independent engineers out to evaluate all of your projects. They have consultants that come in, and it's no different. And then the debt side at a bank goes very deep, and probably, I think DOE went deeper and actually did more engineering related work than you would generally see with a commercial transaction. But the rest was very similar in terms of size, scale, bandwidth, and demands on the team to a commercial transaction.
And I don't know if Jonathan touched on this, but probably the most misunderstood aspect of the loan guarantee program when I get into conversation is people think that they handed over $1 billion check to you, and in Q4, Tom, you got a $400 million check. How does it actually work?
Yeah, I put it in my personal account, and we're all set. Everything's good. No, I think from a taxpayer, there's from my perspective, probably pluses and minuses on how the whole thing is put together.
Yeah.
I think from a taxpayer perspective, I think it's very well done. In that, I can speak in our case. There's a series of milestones that we have to meet. We submit a business plan, and we have to meet a certain series of milestones. So the first award was for $50 million, not 400, it's for 50. And we have to meet a whole series of milestones, and as we meet those, we draw down funds. So I think it's very sensible in terms of the way that it's administered from that perspective.
John, did you get your $1 billion the day you signed the deal?
Not a penny. No, we don't have. And we still don't. So it's a process, and you have a financial close, just like for us, it's a project financing, not a corporate financing. And for a project financing, you need to have your permits in place, your transmission in place, all of the conditions precedent. It's no different than a commercial bank. And so you don't get, your funding doesn't flow until everything's been de-risked, and then you get your debt and your equity. And you have to bring your equity to the table, too. So it's really no different than a commercial closing. And we wouldn't have closed with a commercial bank until, 6-8 weeks from now. And we're not going to close with DOE until 6 or 8 weeks from now. It's the same basic process and the same discipline.
That was probably one of the more challenging things for us, again, being a smaller company, was that we did have several other parts that had to happen at the same time. We were raising equity. We were closing on a factory in Indiana, which will be the largest solar factory in the United States. So that was a significant and a little bit of a hairy real estate transaction. So you're trying to get 3 main transactions closed, and it was sometimes difficult to know exactly when things were going to happen from the DOE side. And you have, private investors, and you have real estate people and a bankruptcy court and a whole series of other parties that need to operate on a particular schedule, and you really can't. You operate, kind of on the clock that happens. So that was a little bit of a challenge in our case.
Let me try and translate something Jonathan said earlier. He said it maybe in a delicate way. I want to just make sure we all understand what he meant. He said, what he has done is essentially he's been part of an execution agency. And what he meant by that was the DOE and the loan guarantee programs had a lot of critique in certain areas, and I think it gets directed sometimes at Jonathan and team inappropriately. There's a number of ways in which I think the program can be improved and has improved. The question is, what deck of cards has the DOE been dealt with by Congress? The program has been laid out by Congress, and Jonathan's team has executed against that. And while he wouldn't answer the question around suggestions, improvements, and ways this can be changed, I'd like to throw that back into your guys' lap. Having gone through this, having seen what could be better, if Jonathan were waving his magic wand, what do you think he would want changed? What do you guys want changed?
Well, if I look at what my suggestions would be if I were able to influence policy and change things, I think that there was skepticism within OMB and other agencies because of history with DOE, and I think that history, bringing in the right capability and the right teams, has effectively been, we got to move past that. Mm-hmm. And so I think that, at this point, I felt pretty good as a taxpayer about the discipline, about everything we went through, about the fact that they'd had 125 companies come in, they selected only 16.
Right.
And you've got to be able to reject, you got to have, and they would get calls from senators about, pick this project, and they had some backbone and said, no, this is not, I don't care. Yeah. This is not a good project, and they've been very focused on that. So I think the capabilities have grown, the team's improved, there's a lot in there, and I think that now there's still some second guessing with other agencies that's not helpful. And I think that if you can improve that and streamline the process, that would be good for anybody who's going through it. That would be my one major recommendation.
Yeah, I guess I would echo much of that. If I had a magic wand, what would I do? I think the good parts, again, from a taxpayer point of view, I think they're very selective and thorough in screening the projects. I think they do a great job of protecting the taxpayer dollars in the way that they structure the loans and so forth. I think taking politics out of it is the reality and also helpful. So if you're thinking of going through this, don't bother to hire a whole bunch of people to get 14 senators on board and all that. It has zero impact. And I think that's the right thing. I mean, I think that the economics and the science and the quality of the business plan carries the day. So I think that's all great. What would I like to see improved? I'd like to see it way faster and way simpler. Again, if you look at the competitive benchmark maybe isn't 1705, 1703, 16, the other U.S. government programs. It's what's happening in the competitive landscape around the globe. So if you look at our competitors, your Chinese competitors, your European competitors, I mean, it happens, much, much, much quicker and much, much more simply. Yeah. So that would be the way. Now, that's not a DOE issue, that's a Congress issue, right? But it would be to try to drive the same or similar levels of rigor, but do it in a much quicker, a 6-month time frame versus a 2-year time frame. And maybe not a 600-page report trying to project what a relatively young company is going to do 12 years from now. You've backed a lot of companies. There's some uncertainty in that.
Absolutely. Right? Let's just actually talk about one other policy issue, which is, I think we talked about $80 billion that Jonathan and team have deployed. How many people think that the government's going to spend $80 billion with those projects? We're not spending $80 billion in projects, right? It's a loan guarantee. And to the extent that you have the protections that you guys describe, our government's not going to be spending $80 billion on projects that include yours. And in fact, actually probably make some money. How do you think about that from a policy perspective? As we think about $80 billion, you guys didn't get $80 billion, you got loan guarantees. Yeah.
I think it's actually it's a subtle point, and not many people really think about it enough, because it's some of the most highly leveraged money
absolutely
that there is. I'm not sure exactly what the numbers are, but it's measured. You're paying a credit subsidy charge that's measured in the tens to hundreds of millions of dollars to get projects built that are in the billions of dollars, and everything gets paid back. And these are very credit-worthy projects, I can assure you. These are not, you look at the nuclear project with Vogtle by Southern Company.
Right.
You've got the Southern Company's rate base. This is a large nuclear project. I think the loan's 7 or 8 billion. And the certainty of getting that back is very, very high.
Yes.
And so you're right, this is a very highly leveraged program. It's very small amounts of budgeted dollars for huge impact on projects. And I think it's been really important in the last 2 years, and this will be less important in the future. You've been dealing with a time where the credit markets went through their worst time in the last few decades, maybe 5, 6 decades.
Yeah.
So you've had a constrained credit market, and now to allow projects to go forward on a thoughtful basis that leverages a small amount of money to deploy a large amount of money. These are projects that would get financed by commercial banks, with the one exception of nuclear. Nuclear, I don't know if it's difficult to get done by commercial banks. We did have one program pull out of the DOE loan and is trying to get something done outside of it. It's going to be hard. I think that the size and scale of those are big, but all the money gets paid back, and it's a very small amount from a budget perspective.
Yeah, I would guess like maybe 1 in 5 people understand the money gets paid back.
Yeah.
When you talk to the average person. I think the other big thing that it does is a huge stamp of credibility.
Yes.
All around the world. Well, I mean, when the U.S. government puts a stamp that, hey, we've taken a look at this over a long period of time, and we believe in this company, whether that's suppliers or customers or technology partners or potential employees or investors, that's probably as valuable or almost as valuable as the money.
That's a great point, Tom. Talk a little bit more about that. Since the award, how has that actually helped the company? How has cost of capital changed? Are you talking to other debt and or equity players? It'd be great for folks to understand that, again, not just in the loan guarantee context. I know there's some ARPA-E recipients in the room. There's a number of others that have that same kind of stamp. It'd be great to describe that.
Yeah, I mean, I think what it does is for people that are kind of around the periphery of the company, it's a younger company. Is it gonna be around 20 years from now and all that sort of stuff? People, they're looking, they're hesitant, they're wondering. Right. And it's a huge stamp of approval, just like getting a great investor or just like getting a great customer. Yeah. So it helps build credibility in the marketplace, credibility with potential employees. I mean, we've been flooded with resumes from people in the industry and suppliers and the whole ecosystem around any company that's necessary to make the company succeed. So that's been very helpful for us. We appreciate that very much.
Yeah, I'm going to come at that from a little different angle, because I agree with Tom on the credibility and the discipline that DOE went through with evaluating this. We've raised $330 million or so of corporate financing from venture capital, private equity, Chevron, BP, Alstom, serious companies that have come in and do due diligence. And the level of due diligence done by the U.S., by DOE, dwarfed any of that. Not to denigrate the venture world and the effectiveness, but right. At the end of the day, it was better resourced. They paid more money to get experts in. It was the most rigorous assessment of anybody. So I think that once you understand that, you start to realize that they are throwing at they're saying it's easy to they're good at saying no. Yeah. And people get upset when they say no, but you want a bank to say no. That's what I think of it as. If I were a bank and I was chairman of a bank, I wouldn't want them to say yes to every. You can't say yes to every loan. Your job is to say this one's not creditworthy, this one doesn't work. Shepherd's Flat is an example of one that was a very, very good project that you had GE in there, and it's not just helping somebody along. It was a very well thought through project, and Shepherd's Flat as a commercial project would have been able would have gotten done without it, but it wouldn't have been as big. Yeah. Right now, it's the largest wind farm in the world. It's got solid returns. It's well thought through. You could not have done that at that scale. This was GE. Yeah. We weren't part of it. It was GE and DOE. You could not have done it at the size and scale, and it was done through, I believe, the 1705 program. I'm looking for Jonathan for a nod. It was 1705. Yeah. So it was a different, and you had the commercial banks participating alongside, which I think is a pretty interesting way to do it, because that way the commercial banks are, you have multiple layers. You have the equity taking risk, you have the commercial banks taking risk, and you really isolate the any of the taxpayer risk, and you have even more filters on there.
So before turning maybe to a different topic, I want to just add one more thing on a policy perspective, since Jonathan didn't say it, but the taxpayers also have protection in that each project, Brightsource, Abound, evaluated on its own merit. And yet, as any investor, we actually have a portfolio, and we're able to deal with risk return on a portfolio basis. Jonathan has not been given that latitude. That's not the way the legislation reads. It's a mistake. It ought to be changed. He ought to be able to evaluate the portfolio as a portfolio and not as individual. And I think we'd be able to see a wider variety of projects funded. With that, let's turn. We'd be remiss not to actually talk about the solar industry with the two of you on this panel. And we have two of the leading private companies in the solar industry. We've seen increased global competition. We've seen a financial downturn. We've seen the repeal of many of the European subsidies. It'd be great to hear from both of you on what your view is on state of the solar industry. Tom, you want to?
Sure. I think the solar industry is a very interesting place to be right now. It's a little bit like the wild, wild west. I guess, my view long term is that the energy industry in total is going to be a defining issue for our generation for the next 20 years, 30 years. I think that renewables will be a significant component of that. I don't know, exactly which technology, how much is wind and how much is geothermal and how much is solar. But there's no doubt in my mind that that's the case. And so I think that, it'll be growth, and it'll be growth. We've seen Ira's charts as he's opened the conference. There's going to be growth, and I believe that growth is going to continue for 20 years, not for, a year or two. Along that path, there's going to be big bumps. I think in 2009, it was, a phenomenal thing that the world went through in terms of the whole financial crisis. 2010 turned out to be a much better year for the solar industry than I think anyone anticipated. The forecasts coming into the year were for maybe 20% growth, 30% growth, and we'll see what the final numbers are, but they're going to be on the order of 100% growth. Yeah. How many large industries are growing 100% these days? Not too many. As we look forward, I don't see 100% growth in 2011. I think we're going to see growth in the market. We don't know what's going to happen with every government and every regulatory decision that's going to be made around the world. Obviously, we're watching what goes on in Germany. That's the largest solar market in the world and has a big effect on all of us. But I expect the industry to grow, somewhere in the 5 to 20% range. I expect prices to come down, and I expect over the long run, this is a cost game. At the end of the day, we have to produce electricity less expensively than conventional power. It'll take some time to get there, but not much time. And the companies that are successful in driving out costs will be the winners. And that's certainly the bet that we've made. And so we need to grow scale, improve technology, and drive costs down. So regardless of what happens in the market, we think the low-cost guy will succeed.
Well said. John?
Sometimes when I hear like the introduction of European feed-in tariffs and things, I start to realize that we're not really in the solar industry.
Right.
There's a solar industry, and I think Tom and others are in a very attractive industry. It's very interesting. You've got you got everything from distributed to middle-sized deployments. But what we do is we're a little different. So sometimes I think of us as we're just a highly efficient, low-carbon emitting natural gas plant. Mm-hmm. I mean, I don't know if a lot of people know what we do, but we have large fields of mirrors that heat up steam to superheated steam temperature. We run it through a conventional turbine. We co-fire with natural gas. So we compete. We provide low carbon energy, but we also provide reliability attributes and all these other things that the utilities want. So we really compete today with natural gas plants that in peakers.
Yep.
So we just happen to get a lot of our BTUs from the sun.
That's right.
So we provide backup services, ramp and regulation, capacity value, all these other attributes that are needed for reliability. So, I think we're in slightly different worlds here, and I think that the PV world is interesting and has its own trajectory. We certainly pay attention to it, but what we really look at is how do you deliver really large, kind of 250 megawatt and up power plants that provide all these reliability characteristics And we're limited more than, we can't do it in areas where you have diffuse sun, so we focus on areas of high DNI, focus in the southwestern US and others. So we really look at how do you displace and how do you integrate with, how do you bring to bear some of the more efficient gas plants and just get a lot of your BTUs for those plants from the sun. So sometimes we're a hybrid, we call them hybrid plants, and they are hybrid, and we then also, as you look at the future, what's happening is peaks are shifting. Right now, solar's very peak coincident if you look at photovoltaic. Peaks are shifting out to 4, 5, 6 in the evening, and so the ability to move and shift with that peak brings, for us, we start to integrate storage in.
Yep.
And so if I look at where our part of the industry is headed, it's towards providing all that reliable, firm power into the afternoons and evenings. And so we're focused a lot on how everything we've done so far is with just sun and natural gas. But now we're looking at how do you, if you add storage, you do two things. You can address those peaks, which is a really important trend that's happening as they move to 4, 5, 6 p.m., 7 p.m. Arizona's already 7, 8, 9. They don't want to do anything unless they can produce there. And also how you can, with storage, increase your capacity factors to where you can do 50% capacity factor. So if you can produce 50% capacity factor, I can compete head-to-head with natural gas on a level playing field. It's a great situation to be in.
One of the topics that's not discussed enough when we talk about competitiveness, we talk about China versus the US, we always think about it in terms of a financing issue, but the pink elephant is actually the permitting issue. And given the size and scale of solar projects, I think you two are in a great position to talk about what trends are you seeing in areas of land use, water. I think you had a big environmental issue right at the very end of your process. We had Carl Pope from the Sierra Club here yesterday. Talk a little bit about permitting issues as it relates to putting up big projects in our space.
Sure, I'm glad to start. I think I'll live in that world a little more. Yeah. But we build very large projects. The smallest footprint we'll do might be 3,000 or 4,000 acres. So, and we have about 180,000 acres of sites throughout the Southwest to deliver about 10 gigawatts of solar to various customers. And so anytime you talk about that scale, you have issues, or you need to make sure you're careful with where you site it. You're thoughtful about all the environmental issues. You work with, one of the big lessons we've learned is you work with the environmental groups very early in the process and think through with them how to do your siting, and you want to bring all that in very early in the process. It saves you a lot of agony later in the process. So I think more engagement early on is really important as you go through a permitting process. And then planning, we've had people come in who haven't built power plants before, and they think, well, I can permit something in 12 months. There was a very well-known venture guy who asked Jerry Brown to waive NEPA and CEQA. You don't waive NEPA and CEQA. That's not a political favor that anybody can grant. You go through these processes, and they're very thorough processes, and you do them right, and you do them properly, and you plan for it. And if you don't plan for 2 to 3 years on anything that's over, what's a wind farm, or you're going to be wrong. Yeah. You just got to plan ahead. You got to be thoughtful about it. So right now we're thinking for plants that we deliver power for 2017, we're already starting that process now. And it's not that expensive if you plan ahead, if you think about it. It's just layering it out, but it's a long process. I think there are ways to shorten it, but you don't want to count on that.
Yeah, I think we are in pretty different worlds. Our projects are much smaller. Our largest project this last year was 6 megawatts. Most of our business has been in Europe so far, about 90% in Europe, about 10% in the US. There's a night and day difference in terms of the permitting process generally to do that scale solar project in Europe than there is in the US. Even relatively small projects in the US can take 6 months, a year, 18 months, 2 years, depending on what state and what the local requirements are, and they're all different. And many communities just don't have a lot of experience with solar. So each of the standards are different in the different states. I mean, it's a real patchwork as opposed to a place like Germany where it's a 3-page form. It's the same form that's filled out in every part of the country. Thousands and thousands of projects have been done, and so it's not a lot more complicated than getting a driver's license. Yeah. And so you can execute a project much more consistently, the timing of it and all that sort of thing. So I think, we talked a lot about the loan guarantee program, but for solar and other renewables, I think to really gain acceptance in the United States, I think there does need to be some real thinking, again, maybe this is at the ideal level, in trying to create more uniformity across the country, to have a more consistent and more streamlined approach. I'm sure for mega projects that will not be the case, but you would think that to put solar panels on a carport is probably not going to cause the world to come to an end. And each time you'd think it might when you go through even relatively small projects.
So I want to transition to getting your questions out on the table, and with his permission, I want to do something I don't know that's been done before, and that is ask Jonathan to come up and be part of Q&A. Would you do that, Jonathan? I don't know that we've had Jonathan.
Only a friend would ask, Jonathan.
I don't know that Jonathan's been on stage with the Dennis.
Yes, Dennis Barons with Dow Venture Capital. Clearly, at the cell level, the business is becoming commoditized over a very short amount of time. And at that point, supply-demand balances become important. Do you guys have a comment on what you see in 11, 12, and 13 as supply-demand balances?
Yeah, I think at all levels, I think in essence this is a commodity business, okay? And supply-demand levels are critical. I think it's a cost game, and you got to get the installed cost per watt lower than anybody in the world. I think that we've seen a tremendous amount of growth in 2010. I think that every company in the world and many governments in the world have reacted to that, and you've seen capacity come online. I would guess in 2011 we'll see more supply than demand growth. So I think we'll see continued decline in cell costs and module costs. That over time, I think, balance. I don't think we're into some crazy structural imbalance, but it's a little lumpy. Some of these plants are fairly large plants. I think over time, I expect that solar growth will be 30-40% a year, not 100 and not 0. And that's certainly the model that we're building on. One of the comments that was made earlier, and maybe this goes a little bit to Jonathan's comment, if we're going to be competitive in solar, you got to be overseas. I don't happen to agree with that assumption. If you look at the lowest cost company in the world, it's First Solar. Now they have plants all around the world, including the U.S. We believe we can get our costs similar to that in U.S. plants. I think the key is technology. There are benefits to being in other parts of the world in our industry. But direct labor costs is a relatively small component of solar costs. And certainly the Chinese today, despite all the subsidies and very low labor rates, are nowhere near First Solar in a cost per watt basis. So there are tax advantages, there are other advantages, but the U.S. can be competitive in this industry, and I would not agree with the assumption that we can't be. I think we can be, but we have to be highly innovative, and you have to have a global footprint in your supply base and in your customer base.
Actually, there's a corollary to that too. I think Tom is exactly right. I agree with everything you just said. One of the things that we look at as well is we feel that it's undeniably important that we also figure out how to build out a supply chain in this country, because while innovation drives cost, you actually can't innovate without having a manufacturing base.
Right.
So the two fit hand in glove.
Good point.
As you build out a manufacturing base, you actually will accelerate innovation and drive down costs further, so making it more globally competitive.
Nick, last question with you.
This is building on the last question, but if there is a full stop in the Italian market, akin to what happened in the Spanish market in 2008, which could lead to an even bigger step function in pricing declines. How do you both intend to manage your both pricing and your working capital?
Well, from our point of view, you really can't control what's going to happen in a market, right? As a manufacturer, we're a manufacturing company. What we control is costs. And, we saw what happened in Spain, Czech situation, go, stop, Italy. I think if you average things over a period of a few years, and when you're talking about deploying $1 billion worth of capital, you're not going to make a decision, go stop. What you're looking for is a long-term trend of what do you anticipate happening with the market. So nobody predicted that the market would double last year. We'll see where Italy goes. We'll see where the German feed-in tariffs go. We'll see what happens with the U.S. market. We'll see what happens with India. We'll see what happens with China. And we'll react to all of those market situations. I think the reality is, at the end of the day, what we need to focus on is costs. And if you're the low-cost provider, probably in about every market situation you're okay. And if you're not the low-cost provider, you can certainly do better. So we'll focus on the things we can control, and we will obviously monitor and react to changes in the market. But my guess is, on a worldwide basis, we'll see somewhere between 5 and 20% growth. Some of that will be in places that we don't anticipate right now. There'll be positive effects and negative effects, and we probably, as a relatively small manufacturer, will not overreact to any of those. We think there's a market for our product. We got to develop our technology and grow our scale.
Yeah, and once again, we come at this from a much different perspective. The panel markets and the module markets and the feed-in tariffs are sort of off to the side for us because we've got right now a very attractive cost structure. So if you look at just the fact that we can produce so much more power and we have such a high capacity factor, it starts at about the equivalent of $2.80 total installs, so buck a watt for the modules equivalent. And then it gets interesting, and that's for the very first plants, but we have a very interesting cost curve in front of us. So we've got the ability, we follow Siemens, GE, the big turbine manufacturers. We look at thermal to electrical conversion efficiency, and that's one thing that those groups are incredibly good at. It was 36% in the 80s. It's 42% now. It moves to 46 already with supercritical. It moves up. So we're in a different world here. To me, the rules we follow and we watch solar module prices, and they get interesting at about 20 cents a watt. It's where it starts to get, 20 cents a watt for a module is an interesting number. Until it gets there, we just got our own cost curve that we focus on, we follow. It's a different world. We have other attributes, we have other reliability attributes, and because of that, we don't really, we've got 14 power purchase agreements, which is 2.6 gigawatts of plants to build between now and 2016.
Yep.
That's the majority of what we can do. So we've got a lot, if things go up and down in Italy or Germany, we're fairly fortunate in that we don't think too much about it. We've got a lot of work to do here just executing on building a fairly large 10 billion plus pipeline.
I want to thank Tom and John and Jonathan for spending time with us this morning. Thank you. We need more entrepreneurs like the two of you in this space. Jonathan, I want to say what I said to Matt Rogers and Kathy Zoe, and to you personally. Thank you for giving up your time in the private sector and do what you're doing at the DOE. We appreciate it. We know how hard you're working. Thanks to what you're doing for the clean tech sector.
Thank you.